Hey, Michael, I'm going to first start off our conversation talking about Macarthur Coal because this is breaking news just this hour. Do you find it surprising that they have recommended that their shareholders accept this bid coming from Peabody and ArcelorMittal, which is at a 6% discount to its last closing price?
Good morning, Susan. Well, I don't think it's surprising, remembering that Macarthur was trading just above $11 when this bid was first announced. The premium of the first bid at $15.50 was seen as quite exceptional. And there was some surprise here that there wasn't immediate acceptance from the Macarthur management of that bid. Now, clearly they played a strong hand here and they've managed to extract an extra 50 cents a share. But that $15.50 bid represented a record price, a price at which Macarthur Coal shares had never traded. So to extract additional on top of that, I think was very good work by the board there. I think they've now acknowledged the reality of it. This is a magnificent price for shareholders and they have no hesitation in recommending it.
All right, so this is likely to go through then if Macarthur steps in and tells his shareholders to accept this bid. What about Macarthur Coal's stock? What do you think? Is it still worth buying in if you can?
There's always the possibility another bidder may emerge. This is a terrific asset. Macarthur produces the highest quality coal that's used in the manufacture of steel. It's sought around the globe. They are the largest manufacturer of that grade of coal. So it's not impossible we could see a later bid here. I wouldn't have thought it likely, but of course you can now lean on that put. If you can buy anywhere close to $16, your worst case scenario is that you accept the bid, and of course if another bidder does emerge, you're likely to benefit from that. So I think we will see traders getting involved today once we resume trading.
All right, it'd be interesting to see. Now, hey, Mike, we were talking about precious metals just now. Have you taken a look at gold futures lately? They're below $1,800 an ounce. Have you seen the highs for the year, do you think?
I think we possibly have. The stars seem to be aligning against gold at the moment. Generally, risk appetites are up. We're seeing more buying of equities across the market, and that means that the investors generally seem to be more comfortable with the view that we have a low-growth global scenario rather than a globe going into recession. And if that's the case, some of the safe haven buying in gold will drop out. Now, we've had unconfirmed rumours that the Italian central bank sold gold last week. There's talks that Colonel Gaddafi, ex of Libya, may be selling gold, and in the short term that could weigh on the price. We do know the Chinese central bank has been a buyer of gold and any substantial pullback should be supported, but we could pull back to $1,500 an ounce here and still maintain the positive trend in gold prices.
Okay, so it looks like it's a risk back on. Where do you go then to put your cash?
I'd be looking at the high leverage plays, those best leverage to growth. They're the ones that have been beaten up hard. Resource stocks in Australia are an easy play, but I'd also be looking at the Hong Kong banks. We did see selling in China yesterday after the announcement of further measures to curtail growth there. I think there's been an overreaction, and given the falls that we'd already seen across the Chinese indices, that's the area that I'd be looking at today.
Now, that's interesting, Mike, because did you read the news that BOA sold its CCB shares and its stake at a discount of 11%? It's still worth buying into these Chinese banks, considering the questions over lending as well?
I think that raises more questions of B of A than it does of the underlying asset there that they sold. It's not unusual where we see a large stake placed that there is a discount. I would agree that 11% is a substantial discount. But as I say, that might have been urgency on the part of the seller rather than the underlying market.